Thanks for joining us today. I'm Will Woodall. I'm with Mike Rarey. Hey, Mike.
Hello.
We wanted to take a few minutes just to talk about our money supply and money regimes grid that we've been developing and forecasting money supply and how it relates to our investment process. So we've got a graph here that illustrates the money regimes and the changing regimes, and we really just want to start to incorporate this into our discussion with clients so they're aware of how we're thinking about the changing economic landscape and the investment landscape. So Mike, take us through this sort of framework that we've laid out here.
Yeah, so you could divide it into 4 quadrants, if you will, and we can start in the upper left. The vertical axis is the rate of change in money supply, and the horizontal axis is just the year-over-year change in money supply. So if you wanted to get into wonky terms, you'd say the horizontal axis is the first derivative and the vertical axis is the second derivative.
Right.
But basically, when you're in the upper left, money supply is low. So money supply growth is below average, but it is rising.
Right.
And as you move yourself around the quadrants in a clockwise fashion, then you get into a point where money supply growth is high. It's above the average of 6%, and it is rising. And then we get down into high and falling. Money supply is still high, but now the rate of change is slowing dramatically. And then finally, we have low and falling. Money supply is low and it is falling.
In point of reference, the 6%.
Yeah, 6% is your vertical, and then 0 is your horizontal. And these regimes mean different things for different asset classes. Generally speaking, if you were to apply an economic narrative when these things occur, and we've thrown some actual quarters and our forecasts up against these regimes to sort of talk around the wheel. But generally speaking, when you're in low and rising, when is money supply growth low? Usually after an aggressive rate hike cycle, after restrictive fiscal policy, money supply growth generally slows. And it is rising because those policies are pivoting, meaning the Fed has flipped from being restrictive to the money supply to being supportive of the money supply. This typically happens when you're coming out of an economic recession, an economic slowdown. The Fed has pivoted from hawkish to dovish, et cetera. This is generally a good time, historically, to own equities, bonds, just about anything.
Right.
It's usually a difficult time to own them because it's usually a volatile time. It's usually a scary time, and valuations are usually low, and it's tremendous amount of volatility. But historically, this is a great time to own financial assets.
Right.
As you go from low and rising to high and rising is good too. I mean, you have an abundance of money, and the Fed is still very stimulative. Great to own assets.
Just like 2020, right?
Exactly. And then you get down into high and falling. This is a pivot point for markets. This is the money supply has grown tremendously, and in order to support the economy or markets or whatever reason. And now policymakers have pivoted to restrain the growth of the money supply. So whether that means no more stimulus checks, or that means we're going to hike interest rates, or we're going to unwind our balance sheet, this is a pivot point for markets. It's generally not good news for equities or bonds.
Right.
This is when interest rates usually start to rise because they start to price in a policy shift. And then finally, you go to low and falling, and this is sort of unequivocally the worst environment for equities in particular. This is when you're wondering where your next marginal buyer of stocks is going to come from because money supply growth is extremely low, and it's still grinding to a halt. The Fed is still hiking interest rates. They're still reducing the size of their balance sheet. And that's usually right before you get back to low and rising when they pivot.
So I notice that we're forecasting that we're on the verge of heading into the low and falling quadrant.
Yes.
So what does that mean, and how do we think about the path from where we are today into that quadrant? Yeah.
So we forecast the money supply at least 12 months in advance based on our 8 input model. And right now, if the Fed is going to hike interest rates as the market expects, which is like 9 rate hikes this year, and they wind down their balance sheet as the market expects, then yes, we should fall into a very unsupportive money regime. Money supply growth would be constrained pretty dramatically. And we would get to the point where by the end of this year, money supply growth year over year could be roughly zero. So if that is to happen, that kind of looks like our bear case. The Fed is hiking more than they want to because inflation runs too hot,
Right.
and they're trying to slow economic growth in order to cool inflation. So how we would avoid that would be if the Fed underdelivers dramatically because inflation comes down.
Right.
And then we could sort of sidestep low and falling and maybe go right back up into high and
Back
rising.
into here, right?
Yeah, we could go back into low and rising or high and rising. We're always updating our projections for money supply 12 months out. So it's sort of like if Jerome Powell makes a statement, that has implications
Right.
for our model for how we're going to forecast money supply. So there's plenty of time to avert the lower left-hand regime here.
What about on the fiscal side?
Yeah, on the fiscal side, a big reason why the rate of change in money supply is going to slow and be falling is because we're coming off the sugar high of fiscal stimulus last year with the CARES Act. And so in order to once again avert this, you would need to see more fiscal stimulus. So whether that's subsidies for gas, for fuel subsidies, or subsidies for electric vehicles, or any other type of stealth stimulus that Congress could pass in a midterm election year, that could also help avert this lower left quadrant.
Yeah. And so I think as you look at how this plays out, how do we incorporate this into our investment process?
Yeah. It's one of the factors that matter. So prices matter first. Primary predictor of the returns you're going to get on an investment is the price you pay today.
Right. Absolutely.
Liquidity matters, or your money regime matters as well. So this is one factor that goes into that. Then growth matters, inflation matters, and recessions matter. And generally speaking, if prices are attractive, growth and inflation are fine, and we avert recession, this doesn't have that big of an impact. Right? It's only when those things all align together and you have prices are unattractive, the money supply regime is unattractive, growth is slowing, inflation is going higher, and there's a risk of recession. And you have to look at all those factors together because they do play off of each other.
Yes, they
right?
do.
So just because we have these models doesn't mean you can just blindly follow them and make great investment decisions.
And the other point, if you could throw that back up for us for a second, the other point that's worth noting or discussing here is as we move around the center here versus these outlying points, just describe the real difference there.
Yeah. There's sort of a circle of trust here right around the centroid where, it doesn't matter which regime you're in.
Right.
You're pretty much around average money supply growth, and it's neither falling or rising. So it doesn't provide a strong signal. It's only when you get significantly deep into one of these regimes that we would rely more on this as a signal. And just as a point of perspective, what's forecasted here for Q4 2022, that is actually very deep in the lower left quadrant. You normally never get money supply growth below zero.
Right.
And it very rarely falls that dramatically.
Yeah.
So that is actually a very sort of deep outcome in the lower left-hand corner.
So maybe just to say it a little differently, if you're in the center here, the center circle that I've drawn, you usually can't get hurt that much. You can't be that wrong. The opportunities to get hurt or to make a lot of money exist on the outer edges of these quadrants. So out here and in here are things to be really aware of as overarching our other factors when we look at the investment allocation. So appreciate you listening to this. We're going to be incorporating this into our regular discussions and our modeling so you can get a sense of how we think about portfolio positioning. And if you have any questions, reach out to us. We're happy to talk about these models in any level of detail you want.